welcome to the first Fortune India Boardroom, which is, interestingly titled, we have thought through this and we have titled it Investing in a Perfect Storm. Now we know that it's never going to be a predictable world anymore, and who better to sort of decode these unpredictabilities than the three people we have with us, three doyens of the markets. Need no introduction: Prashant Jain, Devina Mehra, Naveen Agarwal. So these people are the ones who will take us through the entire, how to navigate the markets. If there is such a formula, Devina and Prashant and Naveen, if there is such a formula, we'd like to know what it is. But we need your inputs on that and what you think the economy is looking like, because the last quarter has, the print for the GDP growth has been a little bit of a dampener. There is expectation that the second half will be much better. So is that going to happen? What are the things we need to do? So with that, I hand it over to my colleague Keshav to take it from there and listen to your views.
Thank you, Saurav. I mean, I'm just raring to go because hearing insights from stalwarts is something that keeps me going. So without much ado, let me just put this, say in investing, they say, never say that this time it's different. But is it different this time? So Devina, if you could start off with, because considering that, all asset classes in 2024, including gold, gave its best ever returns. But can we expect an encore, or are we looking at a perfect storm building up?
So first of all, I never give one-year projections either on New Year or on Diwali time. I haven't done it for 30 years, and only a couple of years ago I got the term for it, which was in Daniel Kahneman's book called objective ignorance, which is things not only that you don't know about, but you cannot know about. So it's rather foolish to comment on things you cannot know about. And interestingly, Bloomberg did a data study of because in US markets there are all this data available for decades of what people project. For example, the S&P 500 projections by all the big names you have heard of, all the big banks, all the big Wall Street firms. And what did they find? That everything is off by 15% points. So if they say it's going to be a 10% increase year, it can be minus 5%, it can be plus 25%. Basically, it's not worth the paper it's written on. That's the long and short of it. So nobody knows what's going to happen in a one-year perspective on any markets. And everyone, for example, in the US predicts most of the time that S&P would move between 0 to 10%. In 100 years, it has moved between 0 to 10% only 14 times. So that's because everybody wants to be where everyone else is, so that when you are wrong, you're all wrong together. So that aside, in terms of what has happened to the markets till now, if you go back, let's say Indian markets, 18 years, there have only been 3 or 4 years when there was not a double-digit correction. So it's nothing unforeseen or unexpected which has happened. And 2023, we did not see a double-digit correction. So after 2 years, you saw 11-12% correction. Of course, the median stock is down a lot more than that. The median stock is down 25-28%, depending on which index you look at. So that's why the pain probably that investors are experiencing is not completely captured by the index. But having said that, I mean, if I look at the Indian market, for instance, I'm not very negative on a 2-3 year basis on the mainstream, stable, large cap stocks. But wherever there's been froth, whether it's been industry themes or micro caps and things like that, there it is all up in the air. Because in those things, if you go back again in history, every time the market falls, the stocks that fall are not the stocks that come back. And especially in small caps. The small cap index itself churns 18-20% every year. So 2008-9, when you saw a 80% fall, or 78 to be exact, in that index didn't come back for 8 years. But after 8 years, that index that came back had very few of the stocks which had actually fallen, and that's the pattern. So my advice for some time has been that if you have made a lot of money, or even if you have not made a lot of money in frothy areas, get out and get into a steadier portfolio.
Right. Prashant, what's your take?
Actually, I would agree 100% with what Devina said. I think this market has been driven by narratives, and narratives are right to some extent, but market often misprices those narratives massively, and that is what has happened. So I think China plus will happen. India should grow in manufacturing, but this is a very long drawn, slow, tedious journey. And when stocks start trading at 80, 100 PE multiples, then I think there is every reason why there should be considerable disappointment. And ditto for small and micro caps. I mean, Devina put it extremely well, and I 100% agree with that. And we have been writing about that in our fact sheets for 2-3 quarters. If you look at the supply of stock, it is huge. And if we scan 20 issues, we feel like barely applying in one. So that's the either quality is amiss or valuations are completely out of whack. If you look at 5-year P&L, you don't see much, only P&L you see is last 2 years. And the sellers are very informed, either it's the PE or the promoters. So selling at very expensive prices, I think one should be extremely cautious in that space. Coming to profit growth, I think it will converge, it has converged, it will converge with nominal GDP growth, because there are very few sectors, if at all any, where in my opinion margins can improve. I don't see margins improving in any meaningful way, and it is well known that India's nominal GDP is growing around 10-12%, which is a very healthy rate of growth. So your GST collections are growing in very high single digits. So that tells you the economic activity as measured in rupee terms. So I would expect, and fortunately the bulk of the market cap is in the large caps, though its percentages come down, but it is still in the large caps. And there we see some very sane valuations. So in a way it is a great market, that the biggest companies, the mega companies, the strongest companies are available at sensible valuations, and the moment you go outside Nifty 50 or maybe slightly beyond that, you will either find valuations completely amiss or quality completely amiss.
Right. Naveen, in your case, you run a franchise which sits across all aspects of the capital market. So how are you seeing the year ahead? I mean, do you see anything that worries you? Or you are anchoring bias that you say that you cannot say even if you see something negative?
So yeah, across all our businesses, I think last 5 years have seen a sizable scale up. There used to be only 40 million Demat accounts in the country in December 2019, and that number as of December 24 stands at 190 million. Even as late as the last quarter of 2024 and for the year 24, that growth in Demat accounts is of the order of 30% even now. If you look at unique accounts, that count would be roughly half of the total count. And what we are observing very interestingly is that there is an interplay between rising number of unique mutual fund investors and Demat account holders. Coincidentally, one of the largest SIP distribution digital platforms in the country is now cross-selling broking product to each one of those SIP holders, and similarly some of the largest broking platforms are cross-selling SIPs to the same investors. We generally believe that a healthy mix or allocation in your portfolio, even within equities, between direct equities, mutual funds, SIPs, ensures that the life of an investor or the duration that an investor stays active in the market usually goes up. So, both the asset management business as well as the broking business have seen exponential growth in the last half a decade. Equally much with this $5 trillion of stock market capitalization, we've also seen explosion in wealth, And as Prashant alluded, I mean, there's a lot of monetization of that wealth that happens almost on a daily basis. You may be seeing, either promoter exits or IPOs or other PE exits, by the promoters. So a lot of wealth is getting created, and a lot of that wealth needs assistance of a wealth manager. So that is the other part of the business that is growing leaps and bounds. So we've generally seen very strong growth rates across, so the financialization of savings is all encompassing. And while there may be pauses in those, growth rates for a year after such a strong growth for 5 years, we think that the next 5-10 years will continue to see very strong, robust participation by retail investors and continued financialization of savings.
Prashant, I wanted to ask you, I mean, taking off from what Naveen said, the number of people, coming into the market, the number of, investors of late, particularly during and after COVID, it's been an exponential growth. And yet you say that, you see the IPOs which come into the market and you don't get excited by most of them. Now, yet, whenever in the small and mid caps, there is a huge, in that sense, I would stick my neck out and call it a bubble in some forms. And now somewhere people are aware of it. That's another point. But what I wanted to ask you is, for these younger, newer investors who've never been in the market, never seen a real downturn of that sort, how do they figure out this madness, which you said the bigger companies are, much more sane and stable, and yet this madness is going on in the middle and the bottom. So how do they figure this out?
So they will figure it out very painfully in most cases. I don't think, because there is no matter what you tell them, because they will listen most to their experience of last few years and not to anything else. And the fact that 15 crore out of these 5 crore demat accounts, 19 crore demat accounts did not exist before COVID tells you what is in store for them, because they have no prior knowledge, no prior experience of how markets function. And I have seen this 4 times in my career. These small caps are like seasonal, whatever you call them. Everyone will make money in this except the investors. The selling shareholders will make money, the bankers will make money, maybe the flippers will also make money. But the flippers will sell, but someone has got to hold the entire stock at some point of time. So I feel personally the losses in this round will be probably the highest ever, because at no point in India's history have 20 crore demat accounts been there. You had 5 crore demat accounts. So I think this time around the losses will be massive.
So Devina, you foresee, is that the storm that we are going to see, the pain that he says that is going to come? How real?
Yeah, I have been warning about this for a few quarters, and we actually underweight the very small cap. We don't look at things below 1,000 crore market cap, but even 1 to 5,000 we cut back, knowing it would hurt relative performance. But the problem with small caps also is that there is no effective risk management. Stop losses don't work. When those stocks fall, they fall like a stone. And neither do hedges work, because the only hedge is a nifty put which doesn't move along with these stocks. So I have had people come, a month or two ago, saying that why are you so conservative? Why do you say risk management first? We are happy. We want to take risk and make high returns. I said only thing that is certain with high risk is high losses. High returns are not certain.
No risk leads to high returns.
So this is. I've had RMs come and tell me ki my client says that we like listening to Devina, but she's acting like Mother Teresa. This is the market. This doesn't you can't be so conservative. But we always say investing is a loser's game. You win if you don't lose. So the first thing has to be that you don't take crippling losses. And as Prashant mentioned, this small cap boom and bust we've seen it many times. I mentioned 2008 to 16. After that, if you remember, there was a mad bull run around 2018. And then in 19, you had a 2/3 fall. And I say, don't forget your school mathematics. that if something falls 2/3, it has to triple to come to zero. So all those small cap managers who are saying I compounded 50% in the last 3 years, I said if you fall 80%, as many of them did in that, and then you compound 50% for 3 years, you're still down 25% from your beginning. So don't forget that percentages are not symmetrical on the way up and down. If you fall 33%, the portfolio has to go up 50% to make up. So that's the risk, and as Prashant said, there's so many new investors and people think they're playing the lottery. I mean, somebody will say, I bought this thing as at 50, it is now 500, I said, up to book kar low profit, but then, they will say, nahi, I think this will go up even further. That's the whole mentality. And because they have not seen the cycles, we all should learn from other people's mistakes, but we rarely do. And there's a very good book called A Short History of Financial Euphoria, a very short book by John Kenneth Galbraith. And that sets out the bubble. And they say even people who can see the bubble think they will get out ahead of the crowd. But the fall always comes suddenly and no one manages to get out. And then you look for villains that, management, stock operator, maybe the central banker, whoever, but also all the so-called small investors or small players who were showing this greed, whether it was in crypto or this or whatever, are also to blame, but they are never blamed, of course, because as I said, people, not just new people, I have family offices level people coming and saying, we will be happy with 30-35% return compounded. I said, how is anybody, no, so-and-so is saying that kar denge, so like, that's the whole point.
So
Prashant, you have family offices as your clients, so how are you managing return expectations there?
we are very clear. We guide for 10-12% Nifty returns. So those who expect higher returns, they will not come to us.
So you kind of say that this is
our view. So but we of course hope to beat Nifty. So if Nifty goes up higher, hopefully we'll do better. But this is our view, and we have explained it in very objective manner. So I'll narrate a small incident which happened recently. So I meet customers almost every day, one to one. And all the RMs know that Prashant will last 1 year, he's been saying 10-12% Nifty compounding, no more over 3-5 years. And so we had this meeting, RM and the client. And the RM asked the client before I could speak, sir, what are your return expectations? He said 10%. So the RM smiled. He looked at me, sir, see, I have got to give you a good customer.
Within your band.
So the customer saw us exchanging glances. He said, why is 10% per month too high to expect? So people are counting returns monthly now. So
That's
so Naveen, does that, Prashant and Devina can say what they are because they are off the gravy train, but for you, like they are saying new demat accounts, people trading, people applying for IPOs, investment banking, wealth, everything, this is the time to make money. But would you say I just saw the clip by Ramdev where he said, mere naam se koi agar aake kare to please don't invest. But will he come and say that, cash out, don't get carried away? Is there an investing series in that sense?
Yeah, see, the good news is that like Prashant cited 92 and 2000 and 2008 and various other instances, there will be corrections, after we've had 5 strong, years bottoming out in March of 2000, there will be corrections. The only good news is that the proportion of lump sum investment that a retail guy is making today is a far smaller part of the overall pool. And as far as SIPs are concerned, volatility in the market, drawdown in the markets have usually only helped investors who continued with those SIPs, and a lot of education by AMFI, the mutual fund distributors have happened. So we believe that while there could be lapses and there are data points out there about what is the kind of lapse ratios, we believe that this whole habit of consistently investing through the systematic investment plans fundamentally embed in them the drawdowns that Devina spoke about, like a 66% drawdown. What do you do? What is the job of an SIP? Like for the same lump sum, for the same SIP amount that you keep investing, you accumulate more units in a downturn, hoping that in the longer term the NAVs are higher. And many of these funds have gone through all those cycles. None of these funds are 3 years old. Some of these small cap funds or mid cap funds and large cap funds, multi cap funds have now a vintage of 20 years or 25 years. So you can see through the data and choose the manager that has responsibly managed your money over
But
this
आपने
time
पैसे
period.
तो 5 साल पहले ही डाले होंगे. I mean, this is
The
a good thing
starting-
to say that
so-
a
so
20-year
the-
track record, but the
So
guy
let me
who's
share with you another interesting insight, that whether you start your SIP at the top of the market or the bottom of the market, the 15-year IRRs won't be very different.
Yeah.
So you can try that math, that you're very, very smart and you can call the markets and you start the SIP at the very bottom, right? I'm assuming that retail investors may not have that insight. And the other guy is super smart and he can call the peaks of the market, and you start at the peak and you look at the returns after 15 years, they'll be ballpark of the same magnitude, maybe give and take some fraction percentage point. So I'm just trying to say that there is an evolution of the market. There are changes that have happened in the market. But what will never change after centuries is that there'll be, euphorias, there'll be crashes, and they will keep happening, and they will more likely happen in the hottest theme that got born last 3 years, or in the micro cap or the deepest end of the pool. So that is something which is given the as Prashant pointed out, the very same markets have a ton of large caps which have roughly 5-year zero return, while earnings have grown. So they are trading at valuations which are very attractive. The same fund offerings are also available today. So I'm just trying to say, and also please remember, the largest part of the market is the large cap. So with all that, I think there are enough checks and balances automatically in the system, and as I repeat, crashes will always come. Corrections will always come. We've seen some double-digit correction, as Devina pointed out, a median correction of maybe more like a fourth. Maybe that number could be 40%, 50% in certain stocks, maybe even higher. But I think overall, if you are a SIP investor, if you are a long-term investor, I think most such investors have been in a good shape, having invested in Indian equities longer term.
Yeah, I mean, just to add to what Naveen was saying, while it is true that if you do this paper calculation, he's absolutely right that 15-year IRR wouldn't differ much depending on wherever you started in that year. But there's also two other statistics that more than half the mutual fund investors get out of the fund within 2 years.
right, the stoppage ratio of
And
6.
also of late, as the markets have corrected, the continuing SIP numbers are falling. So while in theory, yes, if you can live through all the cycles, remain invested, you would make whatever XYZ returns. But in actual fact, investor psychology is such that they exit at the wrong times, you can say.
Yeah.
So that is also there.
My question is to both of you, Devina and Prashant. One part of this we've just discussed, the problems, etc. But there is this whole lineup of private companies. I mean, the startups, storied startups, which had crazy valuations, now coming to the public markets. Now, some of them have had their tests. We know who they are. My question is, from an investor perspective and from your perspective also, how do you view them, and what are the mistakes many of them have made? Do you think those mistakes are now the lessons are being learnt by some of the later ones who have come? We've had cases of, for instance, Paytm had a certain experience, but MobiKwik did not. So what are the changes which you think they are making, and do you think then investors look and sort of absorb those changes and then go ahead?
Just want to add, so are retail investors the new VCs? Because up the profitability journey, so the investor has to see, the VC has already cashed out. So
Correct.
Are the retail investor holding lemons, or is there a real story
So
playing out?
first of all, the retail investor is not even making an investment decision. They think they are playing the lottery. If you look at SEBI data, and this is data of a year ago, I'm sure the percentage would have probably risen by now. Not the funds, but the retail, the individuals who get allotment of a share, 50% of them or a little more than that sell out within a week. If it is a profitable listing, meaning listing at higher than the IPO price, close to 70% of them flip out. So they think they are playing the IPO process. So they are not even
They are playing
looking.
for listing gains, you're saying.
Yeah, yeah, I mean, it's a lottery process. They are not making a decision that is this company worth investing in. And I always say that when you see innovative valuation ratios, you know, in the 2021 thing, you saw either that, you know, I mean, in 2000 it was eyeballs.
You can't do it DCF in startups.
So, and DCF is another matter, but I'm saying that as at any time you see innovative valuation ratios, you're not valuing the company, you're justifying a valuation. It's as simple as that. In the 21 boom, I remember on TV, an anchor asked me that if I put a gun to your head, Devina, which one will you buy? I said, even gun to my head. None of these look worth buying. And you know, there are many, I mean, who knows? I mean, there were projections done for 2035 and all that. And Excel sheet is the most seductive fairy tale writing instrument there is. And you can put any growth number. I mean, no one ever looks at, let alone 10% growth compounded for 10 years or 15 years. 1% growth compounded for 25 years. How many companies are there in India? There's none. There's none. And for 20 years, there's only one HDFC Bank. That's it. Out of 4,000 odd companies, a company which has shown some profit growth every year is only one. And you wouldn't have known it at the beginning of the 20 years. So I mean, in Excel, you can put any kind of growth rate. You can come up with any discounted cash flow value. So after doing a lot of work on DCF, we now no longer do DCF because you really don't know what will happen. I mean, Aditya Puri didn't know where HDFC Bank would be. Jeff Bezos did not know where Amazon would be. I mean, when you make a recommendation or a purchase, at the most you can say this stock will double or triple, at the most. That's the maximum visibility you can have. No one has visibility for 10 years, 15 years. So all these are just castles in the sky that IPO booms come and go. And also very often we talked about the VCs, but very often the listing a lot of it is offer for sale. So it's not even going into the company. So it is the earlier investors cashing out by selling to the market. That is number one. And often the IPO is at a multiple of even the last fundraise. The last fundraise might have been as recent as 3 months or 6 months ago. It is still double, triple that very often. And also you have to think through what is the entry barrier in a business. Very often the entry barrier is, you know, if it is it's not really technology. Most of them are direct to consumer brands or some kind of platform where really the entry barrier is only the money you can put in to build that brand. So if you've proven a model, other people will also come in. You know, this is something I understood it's a slight bit of digression, but this I understood over 20 years ago. I remember Hindustan Lever was getting into atta. And I had gone to spend a couple of days with Amul, even though Amul is not a listed company, just to understand, you know, the FMCG space from the other side. And I said, to our mind, atta doesn't make a lot of sense because, you know, you can have competition. And this I'm talking, like, as I said, 20, 25 years ago, that anyone can, at your district level, at your local level, anyone can put atta in a packet and brand it and sell it. So what do you think? So Amul said that we also don't think atta is such a great opportunity just now. But if Levers proves that it is a good opportunity, we will also launch. So we have the brand, we have the rural network, what does it take? So that's the whole point, that many people also wait on the sidelines for a business to be proven. And you are saying I'm making these massive losses and then I have built this market, but then someone else can come in just as easily. So I mean, basically when it is a boom, people are not really thinking about the business. They are not thinking about the valuation. They think the IPO is a lottery process. That's the long and short of it.
So from what Devina said, Prashant, I'd like to ask you the same question. I mean, how does one then, are the lessons learned? How does one sift the wheat from the chaff? I mean, because these companies will keep coming because there is this whole VC funding period ending and private equity funding, they want exits, and lots of them are already planning. The IPO pipeline, you know very well, is huge now this year. And even, you know, lakhs of crores are being talked about. How does one then look at this phenomenon and what do you do?
I just want to add to that, if you are a CIO, I mean, as a public fund manager, aapko agar 3 billion flows monthly are there. So how would you take a judgment call on the IPOs? Because as QIB, I mean, that portfolio investing, I mean, you would want to kind of invest. But now as a PMS guys, you are saying that you have the discretion of saying no. So is there an approach
Also,
that
is
is
there
very
pressure
different?
from the client, for instance, that no, I mean, we want some of these companies in the portfolio?
So I think these IPOs, even if they are overvalued, even if they are not so good quality companies, I think it is good for the country. Because for the first time, even a small entrepreneur, maybe with not a great track record, is able to get a lot of capital. And I feel out of 100 such companies, 2, 3, 5 will come out which can do exceedingly well. And they can add a lot of value, of course, to their stakeholders, but also to the economy. So to that extent, I think it is not a bad thing, but I think investors have to be.
But investors will pay the cost for it, right? I mean, the entrepreneurs will make money, but
no
investors
one,
agar nahi
but no
bana-
one is forcing anyone to buy. So everyone has to do their own evaluation of these businesses. And I mean, I would evaluate any company going public the same way I evaluate a listed entity. What is the difference? Only thing is here the price discovery has not taken place, but the business evaluation process is the same. So I think there is no difference in how.
But the new age startups, they say that you have to look it very differently from a conventional because you are bleeding. I mean, so that's how do you make a call on,
So it is not easy. So everyone has to define one circle of competence. So there are many companies which we don't have a view on. It may turn out to be good, it may turn out not to be good. So I think it is more about investment discipline of not investing where you don't understand, like what Devina said earlier, objective intelligence. I should know what I don't know. That is very important. See, there are two types of mistakes what any investor can make. One are mistakes of omission and the other is mistakes of commission. Mistakes of omission are those you don't buy something that does very well. Mistakes of commission are those you buy and you lose money on it. So I think it is more critical in investments to avoid mistakes of commission, and mistakes of omission will always be there. As far as flows are concerned, I think India is a 4 trillion market cap. No one is forcing anyone to participate in any IPO or an NFO. You can pass them. There is as much money you can deploy in the secondary markets at all, and that's how I would look at it.
But there is this fear of missing out also.
FOMO. What he said
Yes.
about
Omission.
is FOMO basically.
Yeah.
And to that I have a favorite quote from Richard Branson that you should not basically worry about missing a bus. There's always opportunities are like buses. There's always another one coming along. So you should not try to. The reason why the NFOs come, especially the thematic NFOs, is because there is a FOMO feeling among the retail investors, which is why most thematic funds come towards the peak of that theme, because that is when everybody on the street knows about it. Everyone thinks that my friend has made money in this theme and I haven't, and now there is an NFO on this theme. So I always say that if you want a quick check of where there is froth in the market and what you should avoid all the themes where NFOs are coming, because that's typically close to the peak of the
Naveen,
theme.
what
I
you
mean,
would want
that's
to
what
say
that
to
is.
that? Because you ran a business which was, I mean, it continues to be a theme-led play.
Yeah, I think she's absolutely right. I mean, when do you launch a thematic fund, right? When it sells, and when does it sell? When the recent past performance is very good. So, I mean, she's absolutely right that a lot of these things may be, telltale signs of what is in store, in the coming years. And as far as IPOs are concerned, I mean, a correction like this, a 25% median price correction, is usually, a good reset, because all valuations are at the end of the day likely to be, benchmarked to the comparables listed, right? So, if you have a decent correction in the overall markets, firstly, just the number of lapses of DRHPs that will happen, you will start seeing them go up. But on the other hand, I think the buyers, who are mostly institutional investors, who are the ones who set the price, hopefully will be more cautious about pricing some of these NFOs for the larger interest of every other person involved, because retail usually does not set the price for NFOs.
Right. So in terms of themes, I mean, you are never votary of themes. But how do you see this whole trend now of talking, defense, now it's about renewables. So these are all narratives, like you said that, every cycle you will have a new narrative that comes up. So is renewables the 2007, 2008 infra, or is it this time it's different?
And Keshav, talking of infra, is it the return of infra again after having?
That's what I would say. It's
after
deja
having
vu,
burned
or
fingers. Yeah.
especially so with what Trump has said that drill baby drill, and he's completely anti renewables. What's your take on it?
So I think in these markets, if your question is where are the pockets of excesses, is that the question or?
Yeah, pocket of excesses, especially in case of renewables. That is it, the infra of 2007.
So I think energy is a very boring, very low ROE business.
Right.
Fundamentally, even the best of utilities will make 14% ROE. So you have to price them accordingly. And renewable energy is far simpler than thermal energy. To put up a thermal power plant is extremely complex. To put up a solar power plant or a wind power plant is relatively simpler. So and therefore the competition in these segments is intense. So I would say renewable energy is a business that will grow, but it should be valued appropriately to maybe generating a very low double digit kind of a ROE. And it is a business with no entry barriers. I don't think the markets are pricing this characteristic of the business in.
But there will also be themes, and like renewables, for instance, which are in line with this whole agenda for 2047, the Viksit Bharat agenda, etc. Do you see that actually playing out in a positive way rather than burning fingers for investors?
See, I think the businesses can grow, but as Devina was saying, you have to figure out businesses where there are entry barriers, there are some moats.
Moats, yeah.
And if you look at solar or wind, there is very little moat. If at all there is a moat, it is at what rate can you borrow. So anyone with a AAA borrowing can compete effectively in that marketplace. So I would say India should grow. India's fundamentals are pretty strong. Our markets are good, but one has to be careful of the sectors or themes which were driven by narratives, whether it is small mid caps. Now, why did small mid caps did so well? Because in the COVID collapse, they fell 70-80%. From that low base, the returns are higher, and 3/4 of the investors have no experience prior to COVID. So in large caps, you go back from 60 to 100%, and here you go back from 25 to 100. So you see a 4x, and here you see a 40% return. So of course you are piling in there. So I think one has to look at defense. The same companies, nothing has changed. At 1/10 the price, if you bought, you were heavily criticized. Is something wrong? And today at 10x the price, you justify that price. So I think one has to be careful of two things in investing: the sustainability, the competitive edge that a business enjoys, and what are you paying and what growth is priced.
Devina, the other point I wanted to, continuing on the same lines, is Trump, and his pronouncements, most of them inward looking, the new rise of, or rather the resumption of American inward looking nationalism. How does that play out for Indian markets? Because when we are looking at some of these companies and themes, how does that look at a situation where the US is going to become very, very inward looking, and he's made no bones about that?
Okay, before coming to that, I'd just like to add something to what Prashant said on technology. Not very different from what he was saying, but a couple of other things to keep in mind for technology. One is that new technologies take time to become accepted. Renewable energy companies would be surprised I've been meeting since mid-90s in India, let alone elsewhere.
Right.
And even when the first time the Wright brothers flew a plane, I mean, people didn't believe it for many years.
True.
And but the other thing also is that even when a technology becomes good, accepted, changes the world, it doesn't necessarily make for a good investment. First of all, you don't know which companies would succeed, and which is what Prashant spoke about, low entry barriers. The other thing also is that in the case of renewables, like if you look at the 20th century, which were the two things which fundamentally changed human existence, automobiles and aviation. And both have been a graveyard of companies. Both of them. They changed the world, but they didn't make good
So
investments.
is EV an add-on to that list?
No, that you can't
After
say. But
renewables?
I'm saying you have to be, therefore, be cognizant of the fact that just because you say this thing is going to be very good, so therefore I should invest in companies in this space, the second doesn't necessarily follow from the first. Because you don't know which technologies would succeed. Many technologies have not succeeded. But I was planning to write about it. I was collecting a list. And even if it succeeds, it doesn't mean that it made for good investments.
It's a very interesting point you make, that what is good for the India story need not, at least for the initial few years or whatever, need not be good investments.
But India's story, also we've been talking make in India, we've been talking growth of manufacturing, but what does the data show? I haven't looked at the very latest data, but as of end of last year, manufacturing as a percentage of GDP in India had gone down to 13.5%.
Yeah.
And guess how long back it was when it was in that range? 1969. So we were at 55-year lows in manufacturing as a percentage of GDP. And just for context, about 10 years ago, for a good 5 years, we had a 17.5% range. So we've come down from there, while the whole narrative has been that we've been doing great things in manufacturing, but this is the data. Also, I mean, just continuing with that, if you look at the GDP, also it's been running on a single engine of government expenditure.
Right.
A lot of narratives I hear about companies are also about supplying to the government in one form or the other, whether it's defense, whether it's infrastructure. And again, there is no memory of the fact that at one point the biggest risk in any company used to be that you are supplying to either to the government or the electricity board or something,
Correct.
because the money doesn't come, overruns are not funded, there are like all kinds of things. I was talking to an old-time industrialist, and one of his businesses is defense, and I was asking him, he was talking about again, some more focus on defense, and I asked him that, what about money? He said, yes, defense is notoriously bad about paying money. So, I mean, now all those risks are forgotten. You mentioned infrastructure in 2007-8. I went around, at that time I was not managing funds, I was servicing people like Prashant, and we went around with a presentation saying this is a bust coming, and primarily because you could see the return ratios had been crashing for all these companies. They had been just raising money every year, and that's what they were living on. But very few funds actually pulled the trigger and got out of it. And so that was one of the things which said that I must be in the fund management business and pull the trigger myself rather than go there. And to come back to your question about inward looking, it is not just America. I mean, that has been to some extent partly because of the COVID disruptions, and thereafter that Europe, China,
the
everybody
world at
started
large,
talking about having control over things. So China has been investing a lot in every high-tech area, from pharma and neuroscience to semis and all that. And that is only accelerating because of pressure from the US. So, I mean, let's see what Trump actually does. When he had won, I had written an article saying that people were saying what will happen, and therefore the second order and third order impact on markets. You don't even know what he will do. So, I mean, he has not started off by putting that 60% tariff on China, or for that matter, tariffs on Mexico and Canada, because the whole point is, on one hand, you're saying the average American worker's income has lost purchasing power. If you increase tariffs everywhere, inflation goes through the roof. So some of it is saber rattling. But yes, I mean, everybody will try to control technology so that whole, I mean, that theoretical, all the benefits of free trade that are there in economics textbooks, you don't know how that will unwind. India is not, of course, a big exporter to the US except for IT. So to that extent, the policy vulnerabilities would, I would think, be only for IT in any meaningful form, because we are not like, otherwise we don't have a trade surplus with the US, unlike China, which has a trade surplus with every country in the world, and versus India also, it's been growing and going through the roof. So yeah, so we live in interesting times, and if you wanted to compound uncertainty of a Trump, you couldn't have done better than add Elon Musk to the mix. So you are compounding the uncertainty. So that's what, I mean, the only thing you can be sure is that uncertainty has gone up, but you cannot see the trajectory. And this is something even before he had taken oath, I had written in November that last time around also he was not bad for the economy and the business, no matter how distasteful many of his other views are. And that may well be the case this time around also.
Right. Prashant, you are a flag bearer of PSUs, at least banks and certain PSUs, and you held them up. Today in this market, like she said, that if there's over-reliance of government driving the whole narrative, how would you be comfortable investing in a PSU today?
No, I think it is not correct to look at investments as PSUs or private, in my opinion, and this is what I have always said. The shareholding of PSUs is with the government, but other than that, you evaluate them as any other business. So what do you look for? You look for right to win, potential growth and valuations. And 5 years back, because they had not done well or they had done terribly in the previous 5 years, no one wanted to look. And see, PSUs are only in the economic sensitive areas. There are no PSUs in IT or pharma or FMCG.
Right.
So when COVID happened, the economy suffered. Then economic center oriented stocks suffered massively. So they all went down together, and people thought PSUs are bad. It was basically economy related stocks. And from that extremely low base, they have done well, and because the returns have been higher, therefore everyone has become very gung-ho on them, just like small and mid caps. I think where we are today, I think you need to differentiate. All PSUs are not the same. State Bank is very different from a NTPC, which is very different from a HAL, which is very different from a SAIL. So I think you need to evaluate each of these businesses on their standalone merits, and I would be cautious on, and I have seen this for 3 decades, whenever thematic funds become popular, you need to be cautious. They are popular only because the past returns have been extremely high, and when returns are extremely high, most people extrapolate those returns. I think they should question these high returns, can it lead to a mean reversion, which is more often than not the case. So I don't think we should, at this stage, it would be appropriate to make a generic comment on PSUs, because they are so very different, and they are not either, I mean, the valuations are also reasonable in some cases, attractive in some cases, maybe not attractive in some cases.
Yeah, Naveen, I wanted to take up from what Prashant just said about thematics again. Mutual funds sahi hai. I mean, that's definitely the base on which the fund industry is doing what it's doing, and they're doing pretty well, as the figures clearly show. What I wanted to ask you is that are mutual fund houses also making the same mistake of cashing in on the FOMO in terms of thematics?
Today, if you look at 2024, 2023 data, the largest delta in flows have been in the thematic space, and thematic covers everything. There's some fund house looking at rural as thematic, some fund house looking at innovation as thematic, and somebody looking at healthcare as thematic. So that thematic includes sectors, includes all these concepts. The rare view, the recent past returns are exciting for some of these themes, and that is why they are selling very easily and like hotcakes, right? And some of them are, I mean, recently, one of the asset management companies launched a fund in the very narrow theme that Prashant just spoke about and raised record amount that any thematic fund has ever raised, right? So those kind of things are happening, and I think there may be pressure on some of these asset management companies, to be able to cover the portfolio gaps that they may have. At the same time, I keep reiterating this point that even within the volatile thematics, if you have maybe the right bunch of thematics that you've bought or you have SIPs, hopefully you will be better off. And the assisted, the intermediated advisor, if he can handhold you into doing this, then you are better off. Having said that, the biggest thematic fund collections that have happened in every cycle, you can go back and check the 2000 launches of e-commerce and internet funds. I think they rested at a 2 rupee NAV at their bottom. You can look at the 2008 infra fund launch, and that rested at, I think, 2-3 rupees NAV also. So you have enough precedents of that happening, in the past also. It's not I'm talking about India, I'm not even talking about global precedents. All of these NAVs have fallen 80-90%, when the markets may have corrected by more like 50% or 60%. And so, investors should be cautious about, these rather hot products where the, recent returns have been very, very strong.
So, I'd like to add something to that. So one is that, as Naveen also said, that the thematic fund often come at the peak of the cycle. So some time back, somebody wrote to me on social media saying, you talk against thematic funds, and look, there's this tech fund which was 2 rupees in 2003, and then in 20 years it has compounded so much. I said, very good, it was 2 rupees in 2003. But have you looked at when it was launched? It was timed to perfection. It closed 1 week before the tech crash. So that 10 rupees became 2 rupees in 2 years and odd. And then from 2 rupees, you're counting the compounding. So obviously, when I'm talking to avoid thematic fund, it's mostly the new fund offering. There are a couple of other nuances to that. Many times the title of the fund is not what they hold. So I have seen ESG funds holding Coal India. I've seen small cap funds having 8% in Reliance. I've seen certain fund houses where no matter what the title of the theme, more or less the stocks are the same. So it's just an asset gathering thing. That's one. The other thing is also more fundamental, which is that most of your returns, 85-90% of your returns come from asset allocation, not from security selection. And within equities, you can say it comes from that theme selection. So if I'm leaving the retail investor to decide that should I be in IT today or should I be in defense, should I be in small cap now, then what value is the fund manager adding? That's the main value addition that your fund manager or financial advisor adds, that where should you be? So if you are not obviously equipped to make that choice and you are paying somebody else in the first place to manage your fund. So, it doesn't make sense to decide that now I should be in this theme, and always people come at the tail end. I had quoted this example elsewhere, and that friend was laughing at me that you quoted me. So this is a doctor friend, and she said, I have never invested in equities, including equity mutual funds. But my friends have made a lot of money in defense and PSU, so should I invest there? I said, by the time it has reached you, you can rest assured that story is well discounted. You have never even been in the stock market. So that's what happens, that people get in at the wrong time.
And Naveen, ESG fund holding Coal India, isn't that something which mutual funds themselves should introspect, point one? And also, isn't there some work to be done by SEBI then?
Actually, ESG funds is not such a big deal, but her example, the other two examples that she gave, that irrespective of what the tag of the name of the fund, the portfolios are roughly the same. And so in that sense, you're just more category covering. Wherever you can collect assets, you're collecting those assets. Or, a small cap fund holding, the largest company in India in the largest proportion. I think those are things which I think both the regulator and the respective boards need to have a vigil. While investors should, buyer beware, but having said that, I think there's also a responsibility on the board the respective asset management companies or the ICs to ensure that, they are really true to label rather than, just anything is being pushed in the name of.
And the regulator who's talking about smaller and smaller size SIPs should also look at this aspect, because this is clearly mis-selling in a sense, right?
Yeah, I think that to give due credit to the regulator, they have really looked at a lot of things very carefully.
Yes, they have.
And I must add a comment here that while we are an emerging market, I think whether it is our central bank, our insurance regulator, our capital markets regulator, I think we always talk about near term, whether this thing makes sense or this is painful, but longer term, if you look at last 10, 20 years, I think a lot of the safeguards that have been put in place has made the market a lot more robust. I think we are not that banana republic emerging market like most have ended up becoming. Most emerging markets become frontier rather than developed, right?
Yes.
And at least this market is not looking like becoming a frontier market anytime soon.
The number of transactions which
So,
the market
so,
handles.
so I think this, so across the board, I mean, today again, the new RBI governor is talking about reviewing something that the earlier RBI governor, put in place about liquidity norms for the banks. So I think the attempt to make the market, the whole system robust and more like a developed market like US rather than a, frontier market, I think is something that is also helped, I would say at the end of the day, the investors also, apart from, providing a little more robust system.
To give due credit.
Yeah, absolutely.
No, I totally agree that we are by and large a well-regulated system across the financial spectrum. So.
Even on the derivative side, when it was becoming a little.
Yeah, all the checks and balances
yes.
that X number of investors losing money, etc. I don't think that data is very taken from the market participants, and I don't even know what is the source of that data, because individually the top 3 brokers don't have similar data, and they most of them have shared that out also. But having said that, I think the checks and balances, the constraints that have been put recently are substantial, and despite the contribution that the largest exchange is making, to the exchequer, etc., they've still gone ahead and put those restrictions. So I think at least I feel very comfortable that we have a regulator across various segments in place, which is at least ensuring some robustness to this.
Is that helping, you think, Prashant, Devina, this whole check on derivatives?
It was very much needed because what the SEBI data showed was very scary. It is not just that 93% of people lose money, but if you look at the 7% who make and 93% who lose, the 7% is basically the organized sector.
Right.
It is what is called the foreign participants as well as what they call proprietary traders or something, which is a few hundred in number. And 93% is the individuals. And if you look at the further breakdown, the people who are earning less than 5 lakhs a year lose more. People from non-metros lose more. The less educated lose more. So all of these show basically that the unsophisticated investor is losing a lot of money, and it's the sophisticated investor who's making the money. So it's a very clear thing. And one thing which was, I thought of these two things separately, the credit issues in the market and this, but I had not put it together. And I was speaking at a conference where Mr. K.V. Kamath was speaking. And he said a very important thing. He said, how do you think these derivative losses are getting funded? Whatever it is, 1.5 lakh crores or something of that order. He said, to my mind, it is all getting funded through unsecured credit. And that's where that, the unsecured credit boom is coming from. Because, we had this household debt as a percentage of GDP. It used to be 32%. Then after COVID, it was that it's going up because of the strain in COVID in 2021, but it's continued to go up. It's nearly 43% now. So it's like, it's such a scary
And there also
proportion.
Reserve Bank has been issuing warning signals.
Yes, it
So
has
if we
been.
kind of tie back everything
Right.
to the topic that is investing in a perfect storm as we
Right.
wrap up this discussion.
Right.
So just taking off from what you said, that are we in a perfect storm in that sense? Because you're saying that already there is pain in small and mid caps, and then you're talking of on the unsecured credit, you're seeing microfinance pain in banks. So are we already in a perfect storm? And if you go by the statistics, though it's the FPI selling in the 18 sessions of this year has been much more than what you have seen in the entire of 2008. But the Sensex index just shows you a 2% thing. So while it can be a toast to say that there is this domestic resilience and we have absorbed that much selling, but in that sense, this whole 2 billion or 3 billion of SIP money that's coming in, is it just to cushion the FPI's sales, and will they ever kind of make money in that sense?
So two things. One is on the FPIs. I mean, I'm asked this question all the time, that this is what the FPIs are doing. They're either buying or selling, and this is the unsaid thing is that if they buy, the market will go up, and if they sell, the market will go down. And I always ask that, have you looked at the data? Because, you know, I started this business in 1993, and one of the primary drivers was that the market was open to FPIs or FIIs as they were called then. That they will come in, the market will professionalize, there will be a room for professional research. So that was, so really Dr. Manmohan Singh's budget, where he opened the market to FIIs, was one major trigger. But if you look at the data, the FII buying or selling has no correlation with the market movements and causation is the second step, but there's no correlation to start with. And in the beginning we used to track it, and I still remember the first, obviously in the beginning of 94 onwards, the FII, they had just come in, so every month it was positive. I remember the first month it turned negative to the November, I think November 96 if I'm not mistaken. The market actually went up. So, and very interestingly, 94 onwards is when this money started to come in. There was no domestic mutual fund industry to speak of. And so there was this fresh new slew of money coming in. And you would have, what would you have said? That this much money is going to come into India, Indian market is going to boom. But 1994 to 2003 is the only 9-year patch in the Sensex history where the net return was zero. So, you know, there is no correlation. I always say that, like my maths teacher in school used to drill into us that every step is the next step implied by what you have said before. And the data shows that there is no correlation. And as far as the market is concerned, interestingly, again, if you look at data, what do we have in our minds? That Indian equity markets give you maybe 15% return, 16% return. That's been the long-term return since the indices started. But if you look at not just year to year, but decade to decade, the variation has been huge. So I think the 1980 to 90 decade, it was something like 21%. Next decade, it was 14, then 17. But the 2010 to 20 decade was a disaster overall. You didn't even get 9% compounded. At a time when fixed deposit rates used to be 8%. And you know, that doesn't quite capture it. If you had put in 100 rupees, after 10 years, you would have got 230 rupees. When fixed deposit would have given you around 200. Whereas in 1980, if you had put in 100 rupees, at the end of 10 years, you would have 700 rupees. So that, you know, one decade of much below normal returns is what created the room for this move you've seen from the COVID lows, right, where depending on the index, you are up 200 to 250%. But even now, you are not above the trend line on the mainstream indices, which is why I'm saying that I don't see the risk of a huge crash, because that happens when you are way above the trend line. So that I don't see. The economy is another matter. I mean, here I'm talking markets.
Yeah,
so
yeah,
the economy and markets are two different things. And you know, what better example than China, which made its market high in 2007. And since then, the GDP went up 7 times without it having taken out that high. So that can happen. So that's a different thing. So on the economy, I have several concerns. But on the market, in a medium-term basis, on the steady large cap side, not so much.
Prashant, your take?
No, I would agree with that. And in fact, we have written in our last quarterly also that large caps it makes sense to invest in them. And I think 10-12% compounding on Nifty or large cap stocks is not unreasonable to expect. I mean, markets can fall in the short term a little bit. That's always the case. But I think large caps are okay. One should be extremely cautious on the small mid cap space. See, one thing which has changed in India post 2000 is that India's inflation that used to be average around 9% pre-2000 has averaged is averaging around 5%. So your nominal GDP growth has moved down despite real growth moving up. Your cost of capital has moved down accordingly. And so your profit growth, your stock market returns also will move down commensurately because you are measuring everything in rupees and not in real terms. So I think Nifty that pre-2000 it could compound 15-17% also. But in this environment, I think people say India is a high growing economy, we are accelerating, so return should be higher. No, because your inflation is less, supply is open, every sector is comparative. So I think a 10-12% return in local currency terms from Nifty is reasonable to expect.
Over the next 2.
I think 2, 3, 5 years, I would not worry about not investing in large caps.
Naveen, what would be
Yeah,
your
so after a big earnings growth here in FY24, when we had nearly 30% growth, I think we've seen growth slowing down this year to more like a single-digit growth. Our view is that we should see 12 to 14% growth, and as Devina pointed out, that's the safest number to anyways call out
So you don't
in
see
any
any shocks.
public
You don't
appearance
see
like
any
this.
major shocks then.
So firstly, I want to call out that I don't see any perfect storm here at all. Okay, I see this as a perfect economy, a perfect market. As long as you possess an investment framework, as Prashant earlier pointed out, PSUs and private sector may not be the right way to look at it, and there are many parts of both which may be attractive. I also feel that slicing it as all large caps are attractive and all mid and small caps are value destroying, I think is not something that we subscribe to. We believe that there are very overvalued and untouchable large caps today, while there are very attractive mid caps also, and that's where some expertise of the manager, some investment frameworks, if you possess your circle of competence and you know that this is something that makes sense to me, markets will be volatile and markets will give you an opportunity. In a year when GDP growth has slowed down, in a year when earnings growth has slowed down, in a year when there have been downgrades, in a year when there has been such strong FI selling, right, you will get opportunities also. So we believe that for the QGLP investment framework that we have created over decades, we don't find a major dearth of ideas to deploy our capital, and a very well diversified portfolio can easily be and comfortably be put together. It could have large caps like Prashant highlighted, it could have some mid caps which are probably not understood or where valuations have become attractive. So we believe that constructing a good portfolio which can continue to give the kind of maybe low teens return at least is something
So
that
a
we feel
well-diversified
comfortable.
portfolio is the way to.
And I believe that the overall markets at below average valuations do not to me look like a very alarming situation that we are all in.
Okay, I'd like just to add something to that every investor understands the risk of investing in equity markets is risky, but there's also a risk to not being invested, which is why I say that do not have 100% of your investments in equity, never have 100% allocation to equity. Equity should be money you don't need for at least 5-10 years, but most times it is worthwhile having your equity allocation invested. And why do I say it? That if you look at returns over 40 years, and suppose you miss out on the 10 best days in the market, you would say in 40 years, what is 10 days? But if you miss out on the 10 best days in the market, you give up 2/3 of the return. And if you miss out on the 30 best days, which is not even an average of 1 day a year, you give up 90% of the returns. Like your 100 rupees instead of becoming 80,000 rupees will be less than 8,000 rupees. That is how dramatic it is. So most of the time it's worthwhile being invested when you think things are looking uncertain. It's worth buying a hedge, which is what we did, what we do if we think things are looking uncertain, rather than go into cash, because there's a cost to being in cash. And normally the big up moves come when there is uncertainty, there is fear, where people are asking the question whether it's a perfect storm, not when everything is
Everything is
gung-ho.
fine, right.
So only time the up moves came in a bull market was the Harshad Mehta Teji, because that was a rigged market. But in a normal market, it has never happened. The good days always come when there is uncertainty and fear.
So on that note, we can say stay invested, stay diversified, stay hedged.
Yes, and you know, thank you very much for sharing your thoughts. No better panel we could get on this matter and this topic. The basic research cannot be, we cannot underscore enough the need for looking into the figures and facts and investing with all the information you can gather. That's I think the underlying theme all of you have talked about. There are interesting times, and like Devina also said, that these volatile times also lead to up moves later on. So stay invested and have a hedge, or keep your hedge also intact. I think that's the main theme takeaway from this. Thank you very much once again for coming to
Taking
this
time.
Fortune India boardroom. Thank you.